Right, welcome back, guys. We're going to be looking at our last and very important conference, and that is premium and discounted pricing. Premium and discounted pricing. So, to illustrate premium and discounted pricing, we're obviously going to start with our normal line tool, right? So, obviously, we've got our break of structure, and we have another break of structure at the top. So, what we want to do is when we see price breaking the structure to go and create a higher high, we want to be able to find a tool that allows us to identify a high probability POI that is within discounted pricing. So what is discounted pricing? Discounted pricing is simply cheaper pricing. So if you're going to think of an example of yourself trying to buy something, everybody wants to buy something when it's cheap, right? And everybody wants to sell something when it's at its highest price, or maybe for the sake of this example, to say when it's expensive. So if you think of this in relation to the market, you like to think that if price is going to pull back from a high price down to a cheaper price, which would be much lower here, then you want to find a way to find that cheaper price and stop trying to buy from the more expensive price, because as long as price is still premium, which would be expensive, then it's better to be selling at that price. And as long as price is now discounted, it's better to be buying at that price. All right. So what do we do when we want to identify that? So for the sake of this example, let me just clear this out and draw another line. So I've got price coming here, pulling back down, and then it gives us maybe something like that, right? So now what we have is a scenario where we've got a point of interest here, we've got a point of interest over there, we've got a point of interest over here, and we've got another point of interest right at the bottom. Now, for whatever reason, they have different sizes, right? Now, what we want to do is to pull out a Fibonacci tool from the lowest point before price broke structure to the highest point at which the retracement started, right? And we're obviously going to have this point, which is the 50% point, that is the green line, the 0 and the 1. So everything that is below our 50% point becomes what we call discounted pricing. As long as it's anywhere from this line and below, it's discounted pricing. And as long as it's above this price, it's premium pricing. Okay, so we obviously want to buy only when price comes below into our discounted prices, so that we buy something cheap and we sell something expensive, right? Now in this sort of line chart example, we find that all our areas of interest are below here, but you'll find sometimes it's not always the case. So what you may find is you may have a scenario where price breaks out and it looks something like that. So let me just refix that. So now we've got price breaking out and starting its return down as soon as it breaks out. Now all of a sudden, what do you have? Actually, let me even make it much smaller, like this. So what you have now is price has got the option to come into this POI and reject further up, but we have got reason to believe this is not a good POI to buy. Why? Because it's still in what we perceive to be premium pricing. So it means these three OBs are the ones where we can expect price to turn, simply because these are in discounted pricing. Now, if we're going to incorporate the concept of liquidity and the concept of market efficiency, or our imbalance, then we're going to realize that by the time we combine these two with our premium and discount price tool, we've got more than enough tools to be able to identify the best order blocks, or the best points of interest, or supply or demand areas, right? Now let's look at a scenario where we are trying to be selling by doing this. Let's get rid of everything like that. So we've got price coming down, and then as price comes up like this, we get this sort of thing going on, and we've got our break of structure right there. Now we've got a POI that's over here, we've got a POI that's over there, and we've got another POI over here. Maybe let's make this POI a little bit bigger, like so. Right, so what we begin to notice is, in this scenario, if we simply plot our Fibonacci tool from this low to the high where we expected the retracement to come in, the moment we didn't see these points of interest which are in our premium zone being mitigated, then obviously we got left by the market. The market just maybe respected another point of interest that was in premium pricing, that was in discounted pricing, and continued on. That's perfectly fine, because we don't need to always be triggered by the market. And once we see something like this, we appreciate those are the perks of having rules, and those rules are there to protect us. So if the market does go on without us, that is a perfectly fine scenario. Now, let's just look at another scenario where we're trying to trade against the trend. So in this case, we've got price moving down, giving us a lower high, a lower low, a lower high, a lower low, and then somewhere along these lines we begin to see our reversal schematic forming, right? The question then becomes, what do we do? Because we've seen that here we've got a break of structure to the downside. That's a bear break of structure, and we had another bearish break of structure over there. We had a nice mitigation at a point of interest that we loved over there, and then now we're expecting another mitigation to take place over here. So what do we do? Let's assume in this example we've got another point of interest over there. So we simply draw our premium to discounted tool like this. We identify our order blocks that are, or our points of interest that are within the premium price from which we want to sell. And then if we were to take a buy, we take a buy from our point of interest over there, maybe like this. Let's say our point of interest was there, we get triggered, we take a buy. Now we don't want to buy to the point of getting into this premium pricing whilst we're still in a buy trade, right? So we're going to wait for confirmations as long as they continue to show at a discounted price. Otherwise, the moment that the price begins to approach these areas that are above, that are premium, we want to already be looking for sales. So whenever we do our buy to sell model, we always want to make sure that our entries are at a point where price is still very much discounted. Okay, so in a scenario where let's say for instance our buy to sell model had done this, would we still want to trade from this POI over here? The answer is no, because price has already entered our discounted zone, our premium zone, and from here we have no assurance when price is moving down that this point of interest is going to hold. So there's a higher chance that price is going to come from here and tank and break structure. So once we see price moving into this zone, even if it doesn't trigger us at our point of interest, as long as it has entered into the premium price, then we sort of invalidate our buy to sell model, simply because price is already coming from an area where it has been in a premium zone, right? So we want to try and make sure at every time we are cognizant of how price is moving with regards to the premium and discounted zone zones that we plot on our chart. So every time we buy against the trend, we just need to remember this. And if we're going to look at another example where it would be a buying scenario and we're trying to sell. So let's say we've got the market moving like this, it breaks our structure, and let's do that. Break structure, and we are going to be looking for a pullback. So it gives us our pullback model, right? What do we do next? We already have a break of structure over there, which is bullish, and all we need to do is to grab our discount and premium pricing tool and wait for price to come back into our points of interest that are in the discounted zone. Use our confluences to eliminate these zones. So every time we see any other point of interest that may still be very high up there, we're not interested. So even in a scenario where this looked like that, and the break of structure was like this, or rather, let me do that. So the break of structure was right there, and obviously we had a point of interest like this. We're obviously not looking to buy from such a point of interest. When we see this break, the price break below, give us a change of character, we're happy to sell back into discounted prices. And then when we see discounted prices hold, excuse me, then we take a buy to the upside. So I hope that is a clear model for everyone to understand. I think this is a very simple concept to grasp. You only need to draw this from the lowest point or the swing point before the break of structure. You mark your points of interest and make sure you only select the points of interest that are in discounted pricing whenever you're buying, or the points of interest that are in premium pricing if you're going to sell and continue with the trend. If you're going to go against the trend, then you have to make sure that you're doing it from the appropriate zone. If you're going to buy to sell, make sure you're always buying from a discounted area or discounted prices, and apply that also when you're selling. Right, so we're going to go through a chart walkthrough in our next video, where we'll be discussing how to apply this to a chart.